Hello and welcome everyone to today's digital live event, CREtech Talks, Tech-Enabled Capital Markets. My name is Ashkan Zandia, Chief Intelligence Officer here at CREtech, and I'm excited to be your host today. In a few minutes, we will hear from the most insightful and active leaders in commercial real estate as they discuss their perspective on the impact of the pandemic on our industry and capital markets. While we're waiting for everyone to log into their digital seats, I want to quickly share with everyone a list of upcoming events here at CREtech. Today at 2 o'clock, we'll be hosting a webinar on preparing the built world for the new normal presented by OpenPath. Next week on Wednesday, we will be hosting a webinar, When and How Should CRE Owners Reopen Their Buildings and Businesses, presented by Navigator CRE. Next Thursday, we'll be presenting a webinar on preparing the built world for the new normal, presented by OpenPath. Next Friday, we'll be hosting our CREtech Talks on fully automated multifamily. And on Tuesday, June 9th and Tuesday, September 15th, we'll be hosting our virtual demo day, where you will hear from the most innovative and leading technology companies in the built world. If you would like to use the power of CREtech to be featured in an exclusive co-produced webinar on the topic of your choice to showcase your company's expertise, please email me at ash@cretech.com. That's ASH@cretech.com, or by going to CREtech@cretech.com. Throughout today's conversation, if you, our amazing audience and community, have any questions, please submit them by using the Q&A button located at the bottom of your page. We love to hear from you, so please submit your questions and we'll do our best to answer them. And with that said, I see we have a large crowd gathering, so let's just kind of get the show on the road here. It's my pleasure to introduce some of the most brilliant minds in commercial real estate. In the post-pandemic era of commercial real estate, there has been a wholesale change to how properties are bought, sold, and financed. A true black swan event in modern economic history, today's leaders in capital markets real estate are rethinking and transforming their approach and strategies in today's economic environment. From finance and acquisitions to real estate strategies and tech-enabled solutions, it's my pleasure to introduce our 4 expert panelists as they discuss their near and long-term perspectives on the impact of the pandemic and the innovative solutions and technologies they are using to succeed in today's economic environment. Matt Riebling of Texan. Matt is the CEO and founder of Texan, an owner-led accelerator for real estate technologies where he focuses on acquiring existing assets and developing new assets where the integration of test-worthy and proven technologies will ultimately generate higher returns. Blake Nucci of Tishman Speyer. Blake serves as the Managing Director of Acquisitions and Development at Tishman Speyer, where he is responsible for acquisition and development opportunities in the greater New York area. Andrea Jang of Ackman Ziff. Andrea serves as the Chief Operating Officer at Ackman, where she is responsible for driving operational efficiencies across the firm. Prior to joining Ackman, Andrea served as America's Head of Growth at JLL Spark, where she focused on real estate venture capital investments. Previously, Andrea was a Senior Vice President of Corporate Development at JLL, where she was responsible for driving revenue growth through corporate development, M&A, and strategic talent acquisition. And Adrian Mercado of B6 Real Estate Partners. Adrian is the Chief Information Officer at B6 Real Estate Partners, where he is responsible for the strategic development of the firm's technology platform and oversees the research department and is responsible for the design and implementation of the company's insights strategy. Andrea, Matt, Adrian, Blake, welcome and thank you all for taking part in today's conversation.
Thanks for having us, Ash.
Absolutely, absolutely. Let's just dive into it. Listen, the world has changed. We're all friends here. We've talked a lot over the past few months. What are you guys seeing in the market? Andrea, I want to kick it off to you. You're on the debt side. Lots happened in your world. What are you seeing in the market? How has the world changed?
Well, the world's changed a lot. I joined Ackman Ziff in January, and then we got hit with this pandemic a couple weeks later, and it's been a wild ride. But I would like to just state a couple of things. So unlike the credit crisis of 2008, there exists an abundance of liquidity today. So that's some really good news. Over the last month, there have been numerous articles stating that there's more than $350 billion of dry powder available for distress opportunities, and Blackstone alone has upwards of $40 billion. So what we're seeing today is that if relief programs for tenants, borrowers, and lenders are not implemented, there may be opportunities to acquire loans. And we are seeing this today. We relaunched our loan sales initiative, and this week alone, we've been awarded 2 note sale opportunities. And while these aren't distressed notes per se, things are going to be changing the upcoming months. Another thing that we've been doing recently is that we've been reaching out to our clients to discuss growth and liquidity options through corporate entity level participating preferred equity and traditional equity recaps. We've been receiving tremendous response from a thought piece that we issued out last week through social media and other channels. So reach out to us if you are interested in knowing some of the options that you have available and that side of the business as well. And then from an investment sales standpoint, we've also been very active. We've been awarded an opportunity to help sell a core multifamily asset in Midtown East. This is not a distress sale, but the sponsor is looking for liquidity. Another deal that we are in the market with is a distress opportunity. This is in Inwood. We are representing a nonprofit seller on a 140,000 square foot asset that's slated for affordable housing.
Awesome. Blake, Matt, you guys are on the ownership side. What are you guys seeing there? Like, how has the world changed in your neck of the woods? What are you guys seeing in the market? And Adrian, love to follow up with you on the iSale side as well.
Yeah, Blake, would you like to start?
Sure, happy to, Matt. So look, in terms of new opportunity, I mean, we're really looking at it across 3 different, buckets. There's publicly traded REITs, and a lot of the REITs have sold down fairly substantially from pre-COVID highs. And that's an immediately actionable opportunity to really take advantage of the pricing discounts. And when you think about the order of magnitude, the S&P, I think as of yesterday, was down 12%. And, the office REITs were down 40 to 60% in many cases. And I think you see similar trends across, other asset classes. On the equity side, the private equity side, it's a little bit more challenging to find opportunities. I think, as Andrea said, there's a lot of liquidity in the system, and there really aren't that many forced sellers. And if you're not forced to sell now, there's really not a lot of reason to sell now. And a lot of the lack of forced selling is really driven by lenders working with borrowers to stay in the game and kick out forbear and kick out lender rights. And the third bucket is the debt side, and I think that's a little bit more active, as Andrea alluded to, than the private equity side.
Mm-hmm. Matt, I'd love to get your take on that as well.
Yeah, as a privately held owner operator, and what we're focused on is maybe a bit smaller than what Blake is focused on, but we're seeing a lot of people not needing to sell. A lot of people are pulling the assets off the market if they were intending on selling it in the first quarter. I think the pricing is questionable. We're all seeing lots of data, and that data is making sellers anxious and buyers somewhat anxious. Banks need to show up, and they're busy doing stimulus stuff. So traditional banks, I saw CMBS kind of grind to a halt there for a bit, but things are restarting. And in Texas, I'm isolated in Austin. I love it. It's a great place to invest as well. So we're busy here. We're building. We like the idea of building. We also want to buy, and there's not a whole lot on the market here. Maybe in the future, in the second quarter. And we're also focused on other cities throughout the United States, very similar to Austin. And I don't see a whole lot going on there. No one's forced to sell. And so it'll be interesting to see what kind of assets come around in the second or third quarter, and how we will evolve from this calamity that we're in.
Yeah. So if no one's forced to sell, and the debt market is robust right now, Adrian, on the investment sales side, like, what are you guys seeing? Like, how your investment sales firm, like, how's business? What's going on in your neck of the woods? If no one's forced to sell, how's the industry responding on the iSale side?
Well, I think, there was obviously a hard pause when all this happened. Deals that were sort of slated to go out to market or deals that were in contract definitely paused. I think you're starting to see that thaw a little bit. We are talking to people who are, if they haven't listed, are getting ready to and want to list. I think the biggest issue was sort of where the valuation lies or is right now after this pandemic has started. But we are seeing the thawing of the market a bit. I think it's encouraging for the second quarter. I don't think you'll see people have to sell until another 60 or 90 days once this sort of back end of this really becomes clearer. But New York City specifically, sort of put into context, we were already expecting a slowdown in 2020, right? So I think a lot of business plans have sort of reflected that, obviously not to the extent and with the epidemic occurring to that level, but I think business plans are still relatively intact with some tweaking, and I think those will continue to move forward. We're coming down from highs of 2015, 16 of $77, $80 billion in value of transactions. I don't think we'll get down to the 2009 levels which were under 5 billion, but clearly this first quarter is sort of come to a standstill. But I expect the second quarter to probably will be more active, and I think it'll be more active for all the reasons that everyone sort of talked about here.
I also think that it's prudent to say that even though we're not forced to sell yet, but we're still in pretty early innings here, and you're going to start to see in the next 60, 90, 120 days that people will be not unable to just hold on if they're defaulting on their loans or tenants are not paying rents. There's not other alleviances available. So I think that we need to continue to wait and see what's happening, and things are changing a lot right now. There might not be a lot that's marketed broadly, but there are a lot of trades that are happening very quietly. So we should be mindful of that as well.
Yeah, we can't talk about real estate tech without talk about the first part of real estate, and I agree with you guys. I think the market is currently, when you think about it, we've only been through this for about 5-6 weeks, right? Depending on where you live, right? We've been in quarantine for about 5, 6, 7 weeks, and which feels like forever. It feels like a year already, and every day feels like a Tuesday for some reason. If everyone's working from home, and there are no showings, and there is a lack of ability to execute on deals and actually do any provide any walkthroughs of assets, see even like the guts of a property, the boiler, the plumbing. I mean, how are deals actually getting done then? Like if there are trades, is this done pro rata? Like how is this actually happening? Blake, I'd like to kind of kick it off with you, being the head of acquisitions there.
Yeah, look, I mean, I think the trades that we're seeing are more kind of structured trades where the developer or operator is not necessarily changing. So you may have to have less familiarity with the boiler or the building systems. You're really relying upon an operator to know that. And maybe it's preferred equity or debt. It's a recap in the ownership structure, but it's not a new operator coming in. Look, I guess the flip side could be if there's a building that people generally know and the prospective buyer knows, maybe then it's different. But I agree that, short of those two scenarios, it's really tough to acquire something without doing proper diligence, which involves, physical tours and so forth.
Yeah.
Yeah. And being in the middle of a acquisition at the moment and having to do that remotely is quite difficult, especially when it's not in the same state as me. So, it's, you have to definitely understand that entire process, and the technology there can really help. It's lacking in many senses, but I think people are realizing how that technology can solve for a lot of those problems now, especially when you're talking about building operations and the equipment that's in those buildings, how well they're maintained. I like the data on that front. I'm very curious to see how that evolves, because that could be making things a lot more seamless. I don't need to just rely on third parties to explain things to me. So that's,
I think you're seeing any deals. Yeah, any deals that I think are happening are deals that have already gone through the diligence phase, and maybe, you know, just in contract or getting to that point. I don't think there are very many deals, or there's very few that have entered into the diligence phase after COVID that are slated to close. So, you know, it'd be interesting to see once some of the quarantine restrictions are lifted, how that affects showings, how that affects sort of that final piece of that physical diligence.
Yeah, I heard a great quote. We have a past in our industry. We have a past. We have a future, but, you know, and whatever that future is, but we are currently, the present is extremely blurry, and it'll be interesting to see what the future, when we get out of this, what the future actually looks like, and how our industry has changed. At CREtech, we're firm believers that innovation is the future, and technology is the future. And, you know, with over $2 billion invested in the past 30 days in real estate technology, this sector is performing surprisingly well, especially for later stage companies. We can't talk about real estate tech without talking about real estate first. And thank you for sharing your thoughts. But let's kind of jump into the tech side of this and innovation side of this. On the tech front, what are some of the key tech changes that you're bullish on, you know, that you guys have been using? Matt, I know that you have some very strong opinions there. So I'd love to kind of get your take on that.
Well, on which front? On the building operations front, or just finding those deals in the marketplace today? Because there's a lot.
Matt?
I mean, can you hear me? Can you hear me, Ash?
Yeah, I hear you loud and clear, man.
Okay. So, you know, finding the deal, of course, is
Yes.
is a bit more interesting today. You need to rely on a lot of, you know, what I don't like, I can tell you. What I certainly do not like is having a whole email box loaded of things that I'm not interested in. And, you know, you can go on every one of those brokerage websites and tailor your parameters, but unfortunately, you know, they still flood you with things. You're not able to get to the site as easily. So I would like more information regarding the asset that I'm looking into. That data is not always available, and you know, you have to rely on other people to give you that data. That's something that I'm very interested in seeing the technology come around and do. Make it more transparent, make it easier to understand. I want to know which specific mechanics in the building are last serviced, and how are they currently operating in comparison to, you know, the previous 12 months. That data is really important. You know, in terms of finding the deal, you know, I think there's all kinds of options out there, and that brings me to a whole nother point, which is, you know, there's maybe too many options. For the owner operator, we need something that's, you know, clear cut, easy to jump into, and is encompassing a lot more than just one inefficiency that's out there. It needs to bring a more fruitful, you know, group of things to the table. And so you don't have to go and log into 10 different programs to solve for all these things. That's one of my thoughts there.
I think you said some interesting things there that sort of tie into what we at B6 are doing and trying to do for the future. I mean, to your point where, you know, finding deals or finding information about deals is pretty hard. I think one of our biggest value props in terms of transparency is, you know, is just that, is we try to be as transparent and provide that information to our investors and our clients as much as we possibly can. I think one of the things on the tech front that we've invested pretty heavily in is really understanding who is buying what and who wants to buy what, right? Answering that what question. And that, I mean, takes a lot of different forms, but it involves massive amounts of data from both public and private sources, and integrating that with our agent findings, whether that's, you know, involving items, you know, those keywords like machine learning from calling and understanding, picking out keywords from calls and understanding behavior patterns, understanding when you come to our website or you give us investor criteria, you know, is that really what you're looking for? And trying to tailor and cut through the noise of those 1,000 emails into your box. You know, that's a really important part of what we're trying to do in terms of providing sort of the clarity and the efficiency in that marketplace.
Yeah. Andrea, we talk offline often about real estate tech and stuff. I love your perspective on this too. You know, what are a few of the prop tech technologies that you've been particularly important to you and your deal teams?
So the technologies I've seen that have been really important, especially in today's world, there's a number of things. Everyone's getting very accustomed now from working from home. I think even when stay-at-home guidelines are lifted, a lot of companies are still going to allow voluntary work from home for, you know, a prolonged period of time, maybe even for the remainder of the year. And as such, I think it's really important to be focusing on technologies that have integrated solutions, automated workflows, collaboration amongst teams, both inside and outside of their company. So sometimes you're interacting with your clients, you're interacting with lenders, you're interacting with other external parties like lawyers, you know, general counsel, so on and so forth, but also internally. So collaborative workflows and the ability to track and keep all of that information in the cloud is really important. That being said, a couple that I've seen that are very interesting on the deal side are companies such as DealPath, a deal management platform for investment teams, or VTS, a platform that's being used by leasing asset management professionals. They're really allowing for centralized data collection, collaboration, tools that facilitate distributed work. On the investment sales side, I know that Property IDX has been very, very, very helpful and informative to our investment sales teams. This platform connects owners and brokers to real-time investment sales trends data, investment opportunities, and buyers and sellers through its tech-enabled owners platform. So I'd say Property IDX, DealPath, VTS, and then really just for virtual communication tools, our teams have been using Zoom very actively, and also Microsoft Teams for just information sharing and just being able to interact with people virtually that are not people that you're directly living with at home. I think it's been very, very important that these tools are tools that we can use today. Imagine if this pandemic happened in 2008 or 2009. None of these virtual communication tools existed, and it'd be a very different place in terms of actually doing work. We've been able to operate very efficiently through the use of these tools in today's tech-enabled era.
It's certainly a new era, and the transitions are happening. The transitions are finally happening now, which for me, I look very favorably on that because growing up in real estate and seeing all the inefficiencies, which are just there. I mean, everybody was living with them. They didn't want to necessarily change it because the money that's invested in these things, hey, if it works, keep it as is. But there's so much ways to improve that, and that ultimately it comes down to your bottom line in the property. So for me, that's a huge opportunity, because instead of me always saying, look, yeah, I will push rent and I will lease space, I can do other things too. I can drop OpEx, I can make the whole thing just flow better, work better, make it easier, manage it easier, and that to me is a huge goal in my lifetime. I hope that I can streamline a lot of that stuff, and it becomes much more simple. And I see all those technology companies starting to come around today. So
yeah, on the tech startup side, on the innovation side of the industry, listen, we're all starting to see a handful of companies make huge strides, and like Andrea alluded to, like Blackstone's investment into DealPath and others, but however, data giants like CoStar, made headlines with their recent agreed upon acquisition, of the acquisition platform 10X for 190 million. I paused there for comment from our panel because we're seeing a data company basically entering the transaction market. So I paused there for comment to kind of hear what you guys have to say. Like, what do you make of it? What do you think that signals to the market? Andrea, what do you think?
I mean, I think that we definitely were coming into, even in 2019, we were seeing that 2020 is probably going to be the year of a lot of consolidation. I mean, an acquisition for CoStar like this makes good sense. I mean, CoStar is already a market leader in comps data and the leasing market. Getting a foothold into commercial capital markets, I think, would allow for better countercyclical risk mitigation. I'd also say that, for 10X, they've already gone through a number of iterations, and having this level of capital injection is probably necessary for its continued growth. And I think that going forward, we'll see consolidation from some really big players picking up some of the best of breed, quickly growing prop tech solutions. And this is a way that coming out of this, we'll have some really robust solutions out there.
Yeah. The rest of the panel, same question. What is your take on a data company entering the acquisition space?
I think it's still a pretty heavy data play. I think the analytics and the insights that come out of sort of the platform are really what's, I think, more interesting and most interesting. I don't see it as a threat per se to the brokerage community. I mean, it does give you some questions about sort of what they're doing with your data and what they're doing with your deals, but I think as a whole, especially in commercial brokerage, is a very hard sort of nut to crack in terms of dislocation. You can add efficiencies, but I think at the end of the day, because the fragmented nature of the market, I mean, like even data is so fragmented across market to market, you still need the human touch, if you will, to really still put that together at the end of the day.
Yeah.
I mean, I'd say my 2 cents is I think first, data is going to be a major tailwind, and it's really in the early innings. Real estate's in the early innings of, I think, its own data revolution. That said, I agree with Adrian that real estate, it's typically private market, and since it's not public market facing, the data just doesn't tend to be as good in a variety of instances. But when there is good data, I think it's extremely valuable. Think about a VTS. I mean, right now we're having even more customer contact than we typically would, and as a global company, we're speaking with clients all over the world, many of which have multiple locations with us. And without a system like VTS, it's virtually impossible to really know how a conversation you have in China impacts your business in New York or San Francisco. And I think data, and more broadly technology, really facilitates that. So when there's good data, I think it's tremendously powerful. But you got to tease out the good versus the bad data.
Yeah, I can't agree with you more. I mean, I remember the days when people wanted to actually get like real estate data. They would have to go down to the Department of Buildings or Department of Finance, or and then open this massive book to find real estate information. So I agree 100%. I think getting the right data is key. And so it'll be interesting to see what the future of that company is going to look like and how it all plays out. But Blake, you kind of like touched upon a point there. Many in our industry are very pragmatic, right? It is a very nuanced business, and I don't have to tell you guys this. I don't have to tell our audience this. But even more so in the new COVID era of real estate, if growth and innovation aren't possible, whether it's on the technology-driven side or even ownership side and the acquisition side, the only path back to acceptable ROI or in our case NOI is to address structural costs. What are you seeing there? From real estate professionals, owners, brokers alike, regarding how they're addressing the age-old question, ROI. How does this impact my bottom line, whether it's my return on investment or my bottom line NOI when it comes to growth? Matt, I'll kick it off to you.
You know, I first want to pick up where that last conversation left off, because I mean, I think
By all
several people
means.
touched upon the data and how important that is, and that's really in early stages, like Blake said. I mean, when I say early stages, it's bifurcated. The data is being aggregated state to state, locality. It's not in one place, and if you're doing deals in multiple places throughout the United States, you can't easily get the same data in one place like the other. And I think there's so much data. I mean, the data comes everything from our accounting software to our things like VTS to whatever else data silo that you have. It needs to be aggregated, and it needs to be good data. You need to make sure that it is good data. And everybody can sell data. I can sell some data, and create a company around that. How good it is, you would probably never know. But I think the quality of the data and the aggregation of it, so that I can see it in one place and I can really have it useful for me. That I think is what's coming. And with that, then you have a whole slew of other things that can evolve in the real estate world from that front.
I think I think that's like a really interesting and important point, right? I think the companies that are investing heavily in their data infrastructure and their data collection, right? The most valuable data is the data that comes out of your own organization at the end of the day, right? And so you have companies like Blake has said, VTS, we're sort of putting some of that together. But you know, the companies that are really investing in their data infrastructure and their technology infrastructure, I think long-term are going to be the winners at the end of the day, because that data is so rich and actionable, right? I think the last downturn in 08, 09 sort of brought light that, you know, everybody needed a market report, right? What's happening in the market? And there were no real market reports. And you saw companies come out with these types of analytics. I think this downturn is going to really sort of open the doors for more actionable intelligence versus just sort of data reproduction or data insights. And that data, you know, that data that you get from your company that you can act on quicker and faster in deal making or in any sort of efficiency processing. I mean, those are the folks who are going to really win at the end of the day.
Yeah. And then, so talking about actionable insights, you know, part of the whole point of actionable insights is to drive, at the end of the day, we're in the real estate business here, is to drive revenue, right? And whether, how are we driving growth, basically? How are we driving, again, I point the question back, you know, if we're talking about actionable insights and we're talking about, you know, stuff like that, you know, owners are pragmatic, brokers are pragmatic, you know, I always used to say brokers are basically real estate detectives, and, you know, and owners are the clients of that. And so what are we seeing there on your front? I'd love to kind of get your perspective on that. You know, how are we addressing ROI and NOI when it comes to growth? And to Adrian, you had the last comment regarding, you know, actionable insights. Love to have you elaborate on that.
Yeah, I think, you know, for us in sort of the intermediary business on both the debt and the sales side, you know, it's really understanding need, right, at the end of the day. Mm-hmm. And so for us, the return on our investments that we put in on the tech, which I can speak to, is really, you know, how fast and what value are we bringing to our clients, and, you know, why is that efficiency important to them? Mm-hmm. And so, you know, if we can identify deals quicker, if we can advise our clients, which is something I think brokers don't get a lot of credit for, is, you know, it's not solely a transactional business, right? Like a lot of what we do is advisory work in that doesn't necessarily facilitate a transaction, but it's helping our clients through this data and our technology really understand the portfolio and their options, whether that's on the debt side, whether that's a need for a sale or a sale outcome. So those are the sort of the measurable indicators in the way that we look at the world. Is, you know, the tech that we're investing in isn't necessarily tech for us, right? As a broker, just tech for our clients. And so, you know, being able to provide that level of service or advisory for our clients is, you know, on one side is getting transactions is one ROI, but for them, it's really understanding the best value for their situations.
Mm-hmm. Blake, you know, you sit in a very unique position. You're on the acquisition side. You have within Tishman, there's an innovations arm and a venture capital arm. So you have probably access to a whole bunch of tools that address these issues. And you know, again, you know, the growth and innovation part, if not possible, through innovation and tech. Let's get down to brass tacks. What is ROI and NOI look like for and how do we address that through innovation and tech?
Yeah, look, I'd say there's a couple different categories. There's one, sourcing, right? Finding deals you wouldn't otherwise find. And then there's also managing the pipeline, and DealPath is one of those platforms. The other part of sourcing is like developing investable insights. And I think broadly within data, within the comp stacks of the world and so forth, you could slice and dice data to give you a better perspective on which market is growing faster and asset class and so forth, and fine tune your investment thesis. And then you have, once you own something, you could either increase revenues or decrease expenses. Mm-hmm. And on the revenue side, you know, we think the leasing management platforms like the BTS of the world are incredibly powerful. On the expense side, there's, you know, energy management platforms and the honest buildings of the world, and companies that let you benchmark your expenses, identify ways to decrease expenses. But ultimately, in order to really make money in the business, it's finding new opportunities. And then once you have something, either increasing revenue or decreasing expenses. And the last thing I'd say is just generally efficiency, doing things faster, screening opportunities faster, and so forth. Those are really the barometers of ROI for me.
Yeah. One thing I want to say too about the actionable item front, you know, I don't think when you have a black swan event like this, all your algorithms and I'm sure the quant traders can explain this better than me, but that stuff all of a sudden didn't work out. Those algorithms didn't take certain things into consideration, right? Like this, no one saw this coming. And so I think the data is rich, but something that Adrian also touched upon is the network, the people. It doesn't all just ship to the data. You still need those people there to say, look, I'm reviewing, I'm double checking that data, I'm tweaking the algorithms, and I'm paying attention to and the actionable outcomes. Like if you can get a broad perspective of how your portfolio is truly operating, where are all the expirations? Do I have 30% of my portfolio expiring in 2021? I should be a little concerned. Which ones should I be most concerned with? Instead of me getting that monthly report in the first quarter of next year and saying, oh, wow, look at this. You know, that's something I got to work on, or I got to pay attention to. You can prepare for those things better. And so I think that is an efficiency, which ultimately will come down to and positively affect your bottom lines, in my opinion.
Yeah. I see we have a lot of questions coming in, so I want to get to these questions. Again, if you have a question for our amazing panel, please submit them using the Q&A button located at the bottom of your page. I think we have 20 minutes left in our conversation, so let's kind of jump right into some of these Q&As from our audience. The first one actually came in pretty early, and it's about underwriting assumptions. And so, Andrew, this question is probably going to be for you. Would be good to know how underwriting assumptions have changed / been influenced specifically on office/retail assets, both on the equity and debt side. So yeah, you know, Blake, Matt, Andrea, Adrian, love to kind of I'll get your thoughts on that.
So I mean, I can't, because I'm not specifically on like the day-to-day deal side, but I can say that office versus retail, very different. Just, you know, collections on office have still been very strong. Retail, of course, has been hit and impacted a lot. So the underwriting assumptions definitely have changed based on just in terms of, you know, what's really been happening over in the broader economy. from a debt versus equity perspective, I mean, the markets have really slowed down over the last 6, 7, 8 weeks, but we have been putting out, specific guidance on other ways clients should be looking at, equity recaps and options to just be able to sustain and get through this pandemic and even get through it in a positive direction.
Mhm.
I don't know, like on the ownership side, Blake, have you started to reprice your assets specifically, or are you still looking at
Yeah, it's a lot of wait and see. I mean,
waiting? Yeah.
I think you're right. Collections have been very good in a lot of the major cities for Class A buildings, generally upwards of 90%. The problem is there's really not much tour activity going on right now. So there's not a ton of transactions happening just because people cannot physically get inside space. But in terms of the magnitude, I mean, during the GFC, asking rents fell 30%. So hopefully we're not going into anything like that. But during previous recessions, there is a fair amount of repricing, and it's just unclear if it happens and if it does, to what extent.
We have a question that came via El Jefe, Mike Beckerman. It's for you, Blake. So, hey, Mike, thanks for watching. Tishman has been one of the most innovative landlords in Flexpay with their own solutions. I cannot agree with you more, and I love your platform there. What do you see as the future of Flexpay? So this is a Flexpay real estate question. I would think the pandemic would accelerate the demand for Flexpay. Are you guys seeing that with your solution there?
Sure. And for those of you who may not be familiar with the term, flex space is really just previously in office, or historically, it was always 10, 15, 20-year leases. And once a tenant signed, contractually they had to stay in the space. And given the long lease term, it was very difficult for a tenant to determine whether it's enough space, too much space, not enough space, whether they'll like the space 6, 7 years from now. And really, we work in a number of other companies really set forth the transformation with flexibility, co-working, and so forth. I think certain threads of it are absolutely here to stay. I think that first of all, like during a recession, it's difficult for tenants to really determine how much space they need, right? So there's the economic impact of what we're going through. And then I think it's too early to tell, but you could see tenants say, hey, maybe I don't want to have all my employees in San Francisco, and maybe I want to be a little bit spread out. And if you, in that world in which you are spread out and there are satellite offices and so forth, I would foresee that as being flexible lease term as opposed to 10, 15, 20-year deals. So short answer is yes. I think that there's a lot of tailwinds and it will only accelerate. I think the co-working thing, I think the density is going to be the issue in the short term. Right, co-working and the unit economics are generally enhanced by packing a lot of people into the space, and for the next, however amount of time, that may be a little bit challenging.
Does the underwriting change? So if you can't fit the most amount of people in the smallest amount of space, and you have to now fit less people in more space, does that impact the underwriting?
Yeah, I think as in a lot of businesses, your profit comes in at the end once you cover your fixed costs, and then you have the profit from the final slug of the final tranche of customers. And I think you're right. If you can't have as much density, a lot of your profit may be eroded from the back end. But it's very sensitive to the deal structure with the landlord and so forth.
Yeah, Andrea, Matt, love to kind of get your thoughts on this. Andrea, you guys have the venture-backed experience, Matt having accelerated Andrea in your previous life, and love to kind of get your thoughts on the flex and co-working space. Obviously, it's highly publicized, in the media, but with a handful of companies. But love to kind of just pause there, and hear your comments and your thoughts on co-working and flex space.
Andrea, would you like to take the lead, or would you like me to speak first?
Why don't you go first?
So I mean, I think co-working space is very valuable. and what Blake mentioned, satellite offices. I think a lot of major corporations, you already started to see that a bit before this whole thing happened, but major corporations taking space in these co-working spaces because they like the collaboration, and then they can be a little bit more remote and flexible with that option. I think it's really a good question, because you see it almost in a mini way here with when retail or when restaurants open and they're only allowed to have 25% capacity. Everyone's like, well, why open? And so you just can't make money doing that. And the co-working, I love the co-working spaces. I go to them all the time to visit technology companies or whomever else. I'm in a city and I need to have a meeting, and I'll join someone there. I like the space. It's very useful. I think certain operators of it will outperform because they bring certain specialty, components to it, and they're not just this broad, master lease, and then they're just trying to, find some, desks to sell. I think in the near term that might suffer, but I think overall the concept is pretty solid, and it will come back. To what degree, I don't know. I don't know if it'll be as big as everybody had anticipated it to be, but it'll certainly still be useful space to have.
Yeah.
I think that we'll start to see, and again, we're still pretty early into this. There's definitely going to be a change in the way in which co-working is used, but I don't think it's going to completely go away. It's also, not everyone's just going to start moving into private offices after this either. I think there's definitely going to be a bit more spacing, but eventually there's going to be a vaccine that comes out. People are already starting to see in a lot of different cities that the curve is really flattening and things are declining. And yes, we are concerned about a second wave. We are concerned about the future, but I think that there's going to be changes in which in how the workspaces are built out, and even the materials that are used, plexiglass, maybe like higher kind of barriers between each person. I know JLL and Cushman and CBN, a number of these workplace consulting groups are coming up with a lot of different ways in which you can figure out how to create a new efficient work space and how to outfit it. So I know that a lot of these companies are really trying to figure it out right now. I don't think anyone really has the solution yet, but as Matt says, I don't think this is completely going away. It's right now it's not the most popular tool, but I think it's because over the last few years we've densified so much to a point where it was probably uncomfortable for people to be sitting in 75 square feet per person, but like over 10 years ago, I remember that people were allocated like over 250 square feet or 250 square feet per person. That was too much. So I think it's just, we're trying to figure out what is that appropriate square footage per person that is comfortable and also safe.
Yeah. So we have time for a couple more questions. We have a question that came in from actually one of my dear friends, Tim Malazzo. Hey Tim, thanks for the question. Putting aside CoStar and other real estate data providers, what type of alternative data, for example, foot traffic, social media, etc., will become more mainstream over the next 3 to 5 years? Tim, that's a brilliant question. Actually, that's a great question. I throw it to the entire panel, whoever wants to jump in. Putting aside CoStar and other real estate data providers, what type of alternative data, foot traffic, social media, etc., will become more mainstream over the next 3 to 5 years as it relates to the capital markets and and underwriting and deal making?
Look, I think a lot of those alternative forms are really interesting. We've thought about many of them. I think, we do a lot of residential development, and I can't say we've actually done it yet, but we've certainly thought about the possibilities of tracking social media data to, determine what is the next best neighborhood to build into. And certainly foot traffic could be very impactful there, and retail and so forth. and we've tinkered in these alternative data sets, but haven't actually, ramped up yet. But in short, I think a lot of those sets are going to be very, very interesting.
Yeah. Matt, I'd love to kind of get your thoughts on that as well.
Yeah, well, I think there's all kinds of great data there on the social media front, but social media data can also be skewed and thrown in different directions as well. I mean, you used to be able to pay for Instagram followers, for example. I'm just throwing out something that came to mind there, but there's all kinds of ways where that data can be skewed. So, but I mean, I think if you were to look into it carefully and comb through that data carefully, I think there's all kinds of valuable data there to help you figure out where exactly is the strategic location on where people are going. There's a lot of public data sources too, which people don't know where to find it, or like you said, you had to show up to the courthouse or wherever else, some division somewhere, and pull out the book. A lot of that data is being put on online and digitally, and just people don't know where to find it. And there's certain people that do know where to find it, and that gives them an advantage, right? I know exactly maybe where all the job growth really is happening. Where are the hirings happening? Where do people really want to live? What restaurants are their favorite? And what's the foot traffic on top of that? Compile that data for me. That's not so easy. You have to go to 10 different places maybe, but if you did and you compiled that data, then you have a pretty useful tool to find out exactly where you may want to buy or build next.
So
I think the problem with that data, and those are really great points. I think the problem with that data is a lot of the alternative data is short-term insight, right? And you're trying to plug in so foot traffic patterns can change with sort of third party or other things that you don't have control over, right? So there could be, in 1 year, foot traffic patterns can be one thing. Something opens up down the street that you didn't know about or weren't included in your long-term planning, that can drastically change that traffic, for instance, right? So how do you calculate that impact of the unknown on a lot of alternative data, which I deem as sort of short-term, insightful, no doubt, but long-term planning on some of this alternative data becomes really tricky. Number one, just to put together, but number two, to try and draw conclusions on long-term outcomes. So that data, I think, is really fun to play with. It's really, it can be kind of a cool, shiny toy, if you will, but a lot of it's unproven, especially as it relates to sort of that human movement component.
I remember I went to a tech demo day, and AT&T presented some technology that actually showed cell phone cell receptions throughout the day, and basically hotspots. And it was very interesting. It was focused on Flatiron and in Midtown South area, and it's very interesting to see how people throughout the day, and obviously it's very macro, but to kind of see where densification happens. I think to Blake's point, and I'd love to kind of get your thoughts on this too, and Andrea as well. If densification of humans, not necessarily of space, but densification of people, because at the end of the day, humans want to be around people that share the same common values and beliefs. Do you guys think that kind of information will be extremely valuable for a real estate owner when it comes to acquiring real estate?
Yeah, look, I think just to take it I think that, like any other business, if you're developing a building, you're saying, who is my customer? And you're segmenting your customers, right? So if you're building a condo building in a certain part of the city, that may be different than a rental building in a different part of the city. So once you know who your customer is, then you could really use data to help ascertain, like, will this customer actually like this product and pay this price point?
Mm-hmm.
Yeah, that's a crucial perspective to have. I mean, you can do micro units in one place, which is really maybe a good place to do it. And then you want luxury units, a half mile down the road, primarily just because that's where people are looking to have that type of space. And, that's not so easy just to, that's where the boots on the ground really comes in. I mean, you need someone on the ground that knows that city, how people function in that city, where people like to go. The data can give you that, but I don't know that it solves for everything. The data is a big component in the future, though, for sure.
Yeah. So we have time for one last question. And as I said that, like 15 questions popped up. Love to, so I'm going to I see there's a bunch of technology questions. I'm just going to bundle these all together and rapid fire. Andrew, you're the first person I see on my screen. So we're going to start with you, kind of rapid fire. Okay. And go down the list. So feel free to jump in. So obviously retail is heavily impacted currently, and retail's, I guess, use case has been in question over the past few years, to be honest with you, not just, pre-COVID and during COVID. But with that, okay, being said, what technologies are you bullish on that are solving real estate challenges? And it doesn't necessarily have to be a specific company. It could be just a general technology. But what technology are you most bullish on and most looking forward to? Basically, what's like a technology that's currently underdeveloped that you're very, very bullish on that can help solve many challenges in the capital markets sector?
So there's a lot of topics going on there, and I think I named a couple of technologies today that I think have been doing particularly well and are going to continue to do very well in going forward. Companies such as DealPath, VTS, but one I didn't talk about before that I think is particularly interesting, especially for as we talk about densification, heat mapping, is a company called VergeSense that really shows how people cluster. And it's a people counting technology. I think that now they've kind of pivoted to show corporations and companies where people are clustering to kind of force more social distancing rules and guidelines in specific areas where it might just be a tighter space. So that'll allow for even planning of how do you space furniture and how do you like put signage up so that it just enforces more social distancing guidelines, but also would be really helpful, I think, in beyond office to all other asset classes, based on what we're seeing coming out of this pandemic.
Yeah. Matt, you're up next. Rapid fire. Matt, Adrian, Blake. Okay, that's the order.
Okay. Well, okay, so answering that same question, could you remind me exactly what that person had asked again?
It's a jumbled question of like a bunch of questions in one, to be honest with you, because I want to make sure we're all, we get a bunch of questions in. What technology are you most bullish on for the future?
Yeah, so I would say the people who are behind the strongest data aggregation in one place, dashboarding it, giving it to me how I want to see it, so I don't have to go constantly searching for it. I think that's a huge plus that I'm looking forward to. It also maybe could help me manage the portfolio that I currently have, not just my acquisitions pipeline and everything else in between. But I do really like renewable energies. I like clean energies. I like smart technologies, integrating with those and following that data because I think as that strengthens, I think there will be a lot more push in that sector, even more so than we've already seen. Because I definitely am a huge fan of just dropping my OpEx as much as I can to improve my bottom lines. And this is, to me, a great thing to do right now because I'm probably not pushing rents. So, there's other ways for me to save and make more money in the property. And that's my ultimate goal. The tech, and I've invested in quite a bit of tech companies that I like and that I'm favorable on. That's a moonshot in some ways. Technology investments are a hopeful thing, but you can get hands-on with them and you can figure out and help them, guide them on what the owner operator really needs to help solve that issue. And I think there's all sorts. There's different silos across the board that will make a big impact in the future. So without saying any names, I think certain ones falling in that category are my most hopeful in the near term. And then I want to see where the data goes on the acquisition side, and which brokers will step up and start providing a more transparent, clear-cut view of all the data I need when I acquire a property. And you know, it's not just a war room. Don't just send me a war room, you know? Like, there should be a digital footprint of the building which is for sale with the building. So I know what that historical look is, and it should just tie right into my data aggregation program in all reality.
And speaking of investment sales, up next, Adrian with on the investment sales side.
Thanks for that segue, Matt. Appreciate it. I think more broadly, I think sort of the building system technology is really interesting, even as it relates to capital markets deal making. Just being a little bit tighter and understanding actual in-place items is really important. I think because I'm a data junkie, I think, you know, the types of technology are sort of the cherries of the world, right? Those folks who are really bringing down, you know, hundreds of thousands of data sets that you can pick from through one sort of simple interface that you can then create your analytics and your insights to deliver to, you know, somebody like Matt. So to me, it is data aggregation. It's data, and those companies that are finding creative ways to harness that data is really, really interesting to me.
And Blake, you have the final word.
Yeah, I'd say just to give you a short, data, and then in building technology, sensors and building system technology and so forth. Yeah,
we didn't even touch about IoT, but I couldn't agree with you more. I think IoT has a huge play in the future of healthy buildings. Not only impact on the financial performance of an asset, but also on the health of its occupants and occupiers. So very bullish on the same thing. That's all the time we have for today's conversation. Andrea, Matt, Adrian, and Blake, thank you all for sharing your thought leadership. I hope everyone, including our amazing audience and community, had a great time. I certainly did. I really appreciate the time everyone took today. If you have any questions, our amazing audience have any questions for our panelists, or have any questions about CREtech, about innovation in real estate, or if you're interested in a co-produced webinar, please contact us at Ash, or contact me at ash@CREtech.com or research@CREtech.com. Again, my name is Ash Gonzani. It was a pleasure to be your host today. Thank you all for being here, and thank you to our amazing audience for participating today. Have a great day. See everyone.
Thank you. Bye, guys.
See ya.
Bye.